Okay, so who needs advanced estate planning? Well, currently, if your net worth is over 13.6 million individually, then you may have estate taxes apply if you were to pass away tomorrow, for example. Um, Now, if you're married, you each have that and they can combine it in what's called portability. We'll get into that. And so that's over 27 million. And that's likely to stay in place, by the way. There's speculation whether that might get reduced. Now, with the Trump administration, it's more than likely to remain, but time will tell what happens there and other tax provisions. But if you're wanting to provide for grandchildren or later generations, advanced estate planning can make a difference there. We talked about generation skipping transfer tax in our last month's presentation. But there are some things you can do with advanced estate planning to help with that. Maybe you have a family business or a farm. There are some unique opportunities there. Through proper gifting and estate planning, you can help reduce the taxes and pass on more. Maybe you want to donate to charity or shield assets from the future creditors, potentially an ex-spouse, your heirs creditors or ex-spouses, those of your ex-spouses. So numerous things can be done. And of course, the laws and the tax code are immense. And the question is just whether you take advantage of it and understand it properly. And an attorney can help you with most of these things. So we're just really broaching the topic here. Before I move on, any quick questions? I'm going to make a little adjustment here. Oh, here we go. All right, so some of the trade-offs that you might have would be cost. Working with an attorney to do some of these advanced strategies can easily cost thousands, but it could be worth far more than that in tax savings and asset preservation or extension. So it's always cost is not an issue or is only an issue in the absence of value. You might lose certain financial benefits, of course, by gifting, but you can also benefit up front with taxes. Loss of control is a common thing. In order to get a tax deduction, to reduce taxes for a gift, you have to get it out of your estate. So you no longer can control it. You've given it to a charity, you've irrevocably given it to another family member, and you can't have any benefit from it, or else it gets brought right back into your estate. So a quick review of the federal transfer tax system. During your life, you can gift to your family, friends, in fact, up to $18,000 per year without any paperwork, without any care, without any tax to any individual. Anything more than that, then it's starting to cut into that 13.6 billion, your lifetime amount, and you need to report it so it's tracked to make sure you don't that you are eventually taxed on anything beyond that in your lifetime. So there's a lot you can give away pretty much everything, most people, and not have any gift taxes applied. There might be income tax on certain things depending on how you gift it, or income tax to your donees. But gift tax doesn't apply for most people. At death, then estate taxes could apply, again, depending on how much it's worth at the time. It's a good problem to have. And in some cases, depending on which state. Some states have their own separate estate tax where the exclusion is much lower. It could be only 2 or 3 million. And so that's not the case in Arizona or Colorado, I believe. But it is something that you should be careful about if you move around. Okay, let's move this here. So there's a summary. You also want to be careful about generation skipping transfer tax. If you're going to give to more than one generation below you, you're not going to get away from the first generation taxation. You still have that exemption of the 13.6 million. But once you go through that, of course, even the next generation or second generation down can be subject to estate taxes. Okay, so the unified transfer tax or the federal transfer tax system, we'll say, is a unified system. And so gift and estate taxes are essentially the same on the same level. And again, gifts made during your life are added to the transfers made at death. So they keep track of it. That's what I mean. Outside of the annual exclusion, the 18,000 that you can do, and that'll gradually rise every year with inflation adjustments. So the total amount of taxable transfers can be taxable gifts, depending on how much you've given away, plus the taxable estate. That's your cumulative taxable transfers that can be assessed at death, or as you gift along the way, you'll pay gift tax if it's in excess of that lifetime exemption. And it's when it's valued matters. So gifts are valued as of the date the gifts were made. Transfers are made at death are valued at the date of death. And from there you go. So if you've paid gift tax along the way, that's going to reduce the estate taxes owed at the time of death. But yeah, you're subject to that kind of investigation. If you haven't been paying your gift taxes, then in theory, they would find out what has been gifted. And still, generation skipping transfer tax is separate. So as you can see, it's a pretty high tax rate once you, these are the top rates, and it doesn't take long to get there. They're intended to really eliminate most dynasties, of this perpetual money that's going from generation to generation without ever being taxed. So the idea is that you earn the money, you spend it, or give it to your next of kin, but they want that money back into the system to be taxed and not continually shielded from those taxes. There's always going to be a portion whenever it's gifted if it's a large amount. So again, here are the basic exclusion amounts: 13,610,000 per person in 2024. And you see how it's grown by, depending on the inflation that's applied, it'll grow by extra amounts each year. And so again, given beyond 18,000 will reduce those amounts that are available to you throughout your life. So here's that portability. Prior to 2011, estate tax was use it or lose it. But after that, you could include spouses. So if one spouse died, the surviving spouse could use anything that was left that hadn't been gifted beyond their annual gift exclusion. So kind of supercharge their ability to pass down assets free of estate tax, effectively doubling if there was no use of the lifetime gift exemption. So there's an advantage there to be married, where that money can, or more of it can still be passed down even if one spouse dies. So a good problem to have if that's a family that has that much or more. And the generation skipping tax is the same thing. same amounts that have progressed over the years. But one difference, however, is it's not portable. So once you die, you can't add any unused GST exemption for that second or beyond generation gifting. So there is a restraint on that. You can't combine that with a spouse. So you want to plan carefully if that's the case. So the exclusions, again, I keep mentioning that 18,000, or if you are married, 36,000 if you make the gift together to any one individual. And if you're gifting to a 529 plan, you can forward gift up to 5 years worth, 90,000. Or if you're, again, joint gifting, 180,000 between you and your spouse, even if you file together. So a great way to supercharge a college plan and not worry about any taxes. So definitely it is pro-education. You can also still gift directly to a college to pay tuition, and that totally avoids any taxation. But if you want to still be in control of the student, in a 529 college savings plan, then still you can put quite a bit in there. So there's that. I jumped ahead on that bullet point. So lots of ways to help with education. And don't forget, you can also do direct gifting to a medical provider and not have to worry about taxes if you want to help somebody with their medical bills. And so the marital and charitable deductions can be quite advantageous. Basically, when you pass away, all the wealth in your name, so that might be IRAs or individually owned accounts, especially if you're not in a community property state, can be transferred to your spouse free of any tax. It's unlimited. Now, if it's a non-US citizen spouse, there's a $185,000 annual exclusion. So because they tend to be exempt from the tax system, in many cases, this is a way of limiting abuse of that possibility. And transfers to qualifying charities become fully deductible for income tax purposes and are not taxed for gifts either. So sometimes it helps to equalize each spouse's estate to make the most of each spouse's exemption and optimize the marital deduction as well. So it takes a little bit of planning there, which you can do with a number of tools, kind of an attorney's toolbox here. Some of the more popular types of trusts can be used to help reduce estate taxes. Some of those, when they raised the exemption so high, it used to be only $1 million, back in the 90s or early thousands. And it's gone way up now to over 13 million. It kind of took these out of the limelight because most people didn't have to worry about planning for estate tax anymore, and maybe not for at least another 4 years. But there are some tools here. Qualified terminal interest property trust, which can be useful with a house and keep in control of that house and its value while still allowing a spouse to benefit from it. Or a qualified personal residence trust. They have some similarities there. That's typically more directly applicable to a house, but sometimes Q-tips apply to a house. And there will be some documents here. We won't spend much time on these, but you can request to learn more about these options. The bypass, or commonly known as a credit shelter trust, is, at least it used to be, very popular. They're not as useful anymore, but sometimes they can be, again, to help maximize utilizing each spouse's exemption, but also pass assets down to children up to a certain amount, and not have that tax at all, or subject to estate taxes. So a dynasty trust, there are some opportunities still where you can do that, pass wealth from generation to generation a little more efficiently by using trusts. And GRATs, Grantor retained annuity trust. That's, again, a tool that can spread out payments to a beneficiary while still retaining control of the asset and getting a tax deduction. So each of these have different merits. We'll get into a little bit more on each of these here. Equalizing each spouse's estate. Say John has 10 million, but they have unequal estates. He can transfer some assets to a spouse with a smaller taxable estate and not have to worry about the transfer tax because there is the unlimited marital deduction. So now they each have 5 million. And that may not be enough to worry about now, but with appreciation, it could be down the road. But by splitting it up that way, you can help make the most of each other's exemption. Assuming, and this was assuming that what if they went down to 5 million? Depending on who got elected, there was a distinct possibility to go down to 5 or 6 million. And then this is how you might get around that. It's still a possibility. You just never know what's really going to get voted in Congress and what happens here. So that marital deduction, like I mentioned earlier, you can lose a good chunk to children, but still leave a balance to the spouse. And there's no tax either way. And so the spouse is taken care of, children get it, and instead of it, a big chunk being taken out by estate taxes. So the estate tax, it gets deferred effectively until the surviving spouse's own death, assuming that their own share has grown beyond the exemption, which is less likely because they carved out a portion for the children. And that was set aside irrevocably into this credit shelter trust strategy, or sometimes it's called an AB trust. Lots of different names for them. But every attorney knows about how to do these, and if it's a concern, sometimes it's not so much about estate taxes, but it's about control. Sometimes a family is not so sure what will happen with the surviving spouse, whether they'll remarry, and then potentially that new spouse decides to they have a different plan, and somehow the children get disinherited. Sometimes that happens even with the surviving spouse not knowing. So if you had an unscrupulous new spouse for the survivor, that's kind of what you're protecting against. Or potentially that surviving spouse just overspending and going against what they had planned to leave for their children. Anyway, so it's a way. Sometimes if children are brought in from different marriages, that's going to be a very important tool to use as well to maintain control and assure that things don't get improperly used. And so just to visualize a little bit more how the bypass or credit shelter trust works. So you push money over to the credit shelter trust to utilize the first spouse's exclusion. And then the trust generally provides spouse with access to the assets as needed. And upon the death of the surviving spouse, the remaining trust assets pass to the beneficiaries according to the terms of the trust. So it's really quite simple in nature, but it has to be drafted properly. There is also the qualified terminable interest property trust. So property could be more than just real estate or the residual estate. So basically assets passing to a Q-tip qualify for marital deduction. But the surviving spouse receives all the income from the trust for life with access to some principal depending on the terms of the trust. So it helps protect, again, money from being overspent, but still provides income to a surviving spouse. But their interest in it is terminable, meaning so it can pass down to the beneficiaries. And so it does still remain in the surviving spouse's taxable estate. but again, maintains control while reducing the estate tax overall. All right, so Dynasty Trust, you can still preserve wealth for a number of generations. It survives 21 years after the death of the last beneficiary alive when the trust was created. So in theory, it could last over 100 years, if there's enough of a age difference between grandchildren or great-grandchildren. So it keeps the asset sheltered from the transfer taxes, not necessarily income taxes, well, in the trust. But if you got a lot of money passing down through a wealthy family, there are ways to do it, but there are limitations too. You have that 21-year window after the death of the last beneficiary. So even after that last one, there still is a good while for maximization of assets by avoiding the transfer or estate taxes from generation to generation. But remember, the estate tax and the generation skipping tax are at 40%. That's the assumption here, and the growth rate is 7%. So income or state variables and income taxes are ignored in these calculations. So the GRAT, and there's lots of names. I mean, it goes on and on. Grits and CLATs and CLUTs. There's just all sorts of acronyms in estate planning. This one's a fairly popular one. It removes property from your estate while allowing you to retain some interest. So the grantor retained annuity trust receives the property, and an annuity is paid to you for a certain number of years. So income still is paid to you, but then the remaining, or they call it the corpus, passes to the beneficiaries. But the transfer is subject to gift tax at a discounted value as a result of that. And it's not included. So you still get some benefit from the money while reducing the tax, but it limits, of course, the amount of money that you can receive, and that's all set up in the trust itself. And then there's reducing taxes through the QPRT. Sounds like that video game, right? QPRT, but with a PRT, Qualified Personal Residence Trust. So that one's more specifically used with a house. So you retain the right to continue living in a home for a certain number of years. And if you outlive the specified term of years, the home is not included in your taxable estate, but you must pay market rent if you continue to live in the home. So there's a little catch there. But at least if it's a really nice home, it can be kept out of your estate if that's a concern. Okay, and what about an estate freeze? So freezing the value of property for a person removing it from his or her estate. Basically, it transfers future growth to a person receiving property and allows retention of some control or financial benefit. So a common or more popular one is the Family Limited Partnership, an FLP. Certain private annuities, installment sales, gift or sell leasebacks. So if it's something you expect to grow a lot, the value of a business usually, you can freeze it, just kind of take a snapshot of that value, and that's all that's going to be taxed in your estate. And then the next generation can benefit from it. They'll be responsible for the growth taxes on that, but it certainly can be a way to help minimize taxes to your own estate and allow for more wealth and prosperity to continue in the family. So here's a little more of explanation on an FLP. So it is a business entity that enables the transfer of the business to your children, the next generation. And usually that means the older generation becomes a general partner and they're limited partners. And you basically are gifting up to 99% of the interest in the business to the family member limited partners. But it protects them, the limited partners, from creditors of the business. So it builds some asset protection in here. And then the interests that are gifted limited partners are valued at discounts as high as 60%. So an immediate reduction in that valuation of the assets can really go a long way in reducing that tax. However, beware, if it's not done right, the IRS can easily challenge it and undo it. So you always want to hire an attorney that can specialize in these, that really understands them. Sometimes tax attorneys can be helpful, but that's usually more for litigating. You want to avoid the litigation part and get a good estate planning attorney if this is something of interest. Or maybe you know somebody who is dealing with how to transfer a successful business. So the private annuity, again, is a freeze technique. Property is sold in exchange for a certain unsecured promise to pay specified income to you or your spouse for your life. So the transaction doesn't incur any gift tax and it's completely removed from your estate. So you lose control of the main corpus, but at least you get a healthy income stream from that. Maybe it's 5%. It all comes down to the terms of the trust. And so moving on to charitable gifting. The nice thing is if you can identify beneficiaries while you're living, you can enjoy that money going to work or benefiting the lives of family members or charities. And it's fully deductible for gift and estate tax purposes. And oftentimes you can get an income tax deduction. So maybe a simple bequest or outright gift, certain charitable trusts, charitable annuities, community and private foundations, donor advised funds, that's becoming more popular. We'll take a look at these. For example, the charitable remainder trust is an irrevocable trust that provides payments to you or your spouse for life, and the charity receives the property at your death. And you can change the charitable beneficiary at any time and serve as a trustee and control the assets. So you can get a nice deduction as well and get income, but the idea is that you're going to leave the main bulk of the assets to a charity, but you retain control. And you may find in the world of philanthropy, it's emotionally difficult to give money away because you want to make sure it's being used right. And sometimes you relinquish that control. That can be very frustrating. And so it ends up being kind of a full-time job sometimes to be a philanthropist because you're so involved in the donees or the beneficiaries of that. But you might lose certain tax benefits if you have too much control over it. A charitable lead trust is where the charity receives payments during your life, but then the main corpus of the asset stays in the family. So again, you get a tax deduction. And it channels future appreciation to beneficiaries estate tax-free as well. So the value of the transfer gets reduced by the value of the payment stream to the charity, but you and your beneficiaries receive the principal when the trust period ends. So it's basically a CRT in reverse. And it just depends on what you're trying to accomplish and how can you best benefit the charity. A donor advised fund, or a DAF, that's an alternative to a private foundation. So it's easier to create and manage. In fact, a lot of financial institutions, including LPL, offers those. And you invest your donations into the fund, which then makes grants to charities. You can offer advice, which oftentimes gets followed, but they're not required to follow your suggestions on where that money goes. You can do it anonymously as well, and there's an immediate income tax deduction. So it's kind of an easier way to gift if you're not too particular about who gets it and how it's used. But and more often than not, your wishes are going to be followed. They're going to give you options, and that's where the money is going to go. They're just making it easy for you. And so it's more popular with investment accounts as opposed to like giving away a business or real estate. You just send money into this donor advised fund and get to see that it's being enjoyed and get that tax deduction. Sometimes you can just give directly to a charity. There's lots of those, and you can get state tax deductions on those too. But if you're looking to do something a little bit more sophisticated without getting too much in the weeds, a donor advised fund can still keep it relatively simple. And then there's just general asset protection. Yeah, your wealth could be vulnerable to future creditors. You have some state and federal law providing protection, such as in IRAs, 401ks. There's homestead allowance for your house. It varies a bit from state to state, but generally speaking, you have quite a bit of protection built in on retirement accounts. But you always want to make sure you have adequate insurance. Popular insurance for that would be umbrella. It's added onto your home and auto typically. You have to have certain minimum levels of auto and homeowner liability protection already in place, but then for any excess claims, you can have that extra protection with umbrella. And again, that would be more for non-IRA assets because you have a large amount of protection with IRAs anyway, and can help keep you out of lawsuits. So some of the advanced strategies are available. You form a business entity and hold business assets and then transfer the assets to a protective trust. So basically you own an LLC with a trust is sometimes used to provide some layers of protection against creditors. So here's a simulation of that. Just basically putting a business entity into like an LLC, but then owning it by a trust can provide that extra protection. So S Corp, LLC, but a sole proprietor doesn't necessarily give you that protection. And there's different tax consequences depending on which one you set up. You can also do what's called a self-settled domestic trust. So that's where you name yourself as a primary or even sole beneficiary of a self-settled trust. The trustee has discretion to distribute or not distribute trust property. And the creditors can only reach property you have legal right to receive, but unable to reach property while it is in the trust. So once the property is distributed to you, though, then creditors have access to it. So it's basically kind of a temporary safe holding. And you set up the rules, and then it's in. You got to play by the rules. Therefore, creditors can't get to it right away if it's in that trust. There's also offshore or foreign trusts, where U.S. courts have no jurisdiction. And the creditors have to commence suits in the courts of foreign jurisdiction and work with attorneys in that foreign jurisdiction. There's extra fees and costs for that, but it could deter creditors from pursuing action. It just makes it hard. And you got to play by the rules, or it could become illegal, whether it be US or the foreign laws. So that rounds out some of those strategies. And like I said, there's going to be some extra ones here. But the questions to ask now are, do you think estate tax is going to be a concern for you? Especially if the exemptions remain where they're at. 13.6 million per person, over 27 million per couple, if you haven't already done a lot of gifting. And do you want to give or leave property to your grandchildren or to a charity? Most of the times, no problem, no estate tax, maybe some income tax to them. But if you gift smartly, whether you're living or upon death, and you make it clear, you can still see that your legacy and wishes are carried out. If you have a business or a farm, there are some extra rules and opportunities there. And if creditors could become an issue, you never know. you want to build in some adequate protection. It's a good idea to contact your auto and homeowners insurance about umbrella and learn what it takes there, because it helps. Sometimes insurance you can get can help you, but not much when it comes to smaller policies or trip insurance or, you know, valuable personal property. What they cover is limited, but the catastrophic kind of stuff, getting sued for an accident or something that happens on your property or in your car, could amount to hundreds of thousands, millions. That's where having extra protection can make all the difference. So you want to protect against the catastrophic risks. And that's, like I say, umbrella can help with that quite a bit, or putting assets into an LLC if there's a business interest. That can help quite a bit. But extended warranties and stuff like that, they usually don't pay off. Occasionally they do. It's a gamble, right? You have to ask yourself, would this be catastrophic to me? That would be one that probably is. You never know when you might cause an accident that could cause catastrophic claims against you.